We will discuss what is working capital. Working capital is the money required to run the day-to-day operation of the company. In terms of formula, this is current assets minus current liability. But what this formula depicts is that how much cash a company should have in their day-to-day in the office for day-to-day operations. If they have too much cash, again this is a problem because this is idle cash. It's not been utilized, it's not been revolved to make money, because when we talk about big companies invest for 1 day, 7 days, 14 days, 20 days. They have financial products, money market, treasury bills in which you invest for 10 days, 12 days, you get the interest because the amount is huge. You get some money from customer, you didn't deposit into the bank for 10 days, you bought some treasury bills. So after 10 days when you get the return, you return and the principal amount you can deposit in your account. So this is how we have to understand. Now working capital management includes how to generate the cash. What would be the optimal cash level for you? How much cash you should have? Suppose as an individual, how much cash we should have in our pocket? 1,000, 2,000, 5,000, 10,000, 100,000. If my spending is like this, I go in a shopping mall, I spend 20,000 in one go, I should have 50,000 in my pocket. If someone goes like he spent 20 dirhams, he should have 1,000 dirhams. More than enough for him. So depend upon the size of the company, number of the employees, the expenses they have, they will determine what is the adequate size of the cash they should maintain in the companies. Now how the cash will come? Cash will come from customers or from loan or from owners. These are three sources of the cash. Then cash will go out for supplier payments, for interest payments, and for dividends. So this is the cycle of inflow and outflow that we have to manage. If our outflow is more, inflow is less, we are in cash deficit. Means we are in crisis. If today your rent installment, you bought a home, you have a lease installment, you have a car, you have a lease installment, your DIVA bill, your utilities, this, 25,000, your salary is 10,000. So every second month you will be on the road. Bank will take the home back, car will go. You will be in police for recovery. Same for the companies. If they have more expenses, they don't know what is their expense and they have less money, so it will be a mess. So we have to learn this today, that how to be efficient, how to maintain what is the maximum minimum cash that we should maintain, what is the best amount of cash that should be maintained in the company, what are the different models theoretical that will tell us how to determine the economical and most feasible amount of the cash. Then what is the source of cash and what is the spending, where we spend these items. Directly related to the receivable management. What is receivables? You made some sales on credit. Now you have to receive money from them. Maybe you will give them 60 days credit, 90 days credit. Once they sold, once you sold items, now 60 days after they will give you the money. In nowadays recession, 60 days becomes 90, 120 days naturally. But you have a follow-up system. Before it is, you receive a call, okay, this is my invoices due. You should have a strong AR in charge receivable, and then you have an account payable in charge also. So any delay in the receivable will be claimed for you, because the money that you have to receive from customer is not being received by you, is not given by you. Same way, inventory management. Inventory, you are spending money to create inventory for you, outflow. Ideally, it comes in the mind that we have to buy on credit, say 90 days, and we have to sell. If we sell on cash, the best. We get the money, after 90 days we have to pay back. This is the most smart, effective, ideal working capital cycle, in which you don't need to invest even a single penny. You order some stock, it came, and you sell it, and you sell on cash. Customer came, he gave you cash on spot. Out of this cash, you pay your suppliers. After 90 days. This was the smartest. Most of the financial controllers in UAE are unable to use this concept. Maybe because of lack of knowledge or expertise, whatever it is. But the best CM, the objective of a CMA or a good financial controller is to create the smart working capital. Now I will start off my discussion, working capital. I hope the scope of the discussion is clear to you, what we are going to discuss. Working capital finance concerns the optimal level. Optimal word shows which is the best level by considering all factors. It is optimized in the best way. So mix and use of current assets and the means used to acquire them, notably current liabilities. The formula generally is working capital is equal to current assets minus current liability. Current assets are your receivable, currently receivables, and current liability is your currently payable. Currently means less than 1 year. If your assets are more, liabilities are less, means your working capital is positive. If it is positive, then it's good. Then it leads to the ratio analysis, liquidity ratio. Liquidity is the power to convert the asset into cash. This we will discuss in the ratio analysis unit that is separate from here. The objective is to minimize the cost of maintaining liquidity, which while guarding against the possibility of technical insolvencies. We want ourselves to be safe from the non-payment issues, defaulting. So that's why we have to maintain the working capital for us. From a financial analyst perspective, working capital equals current assets. Its components include cash, marketable securities, receivable, and inventory. You can see all these items in the balance sheet, which is now statement of financial position, right? From the accounting perspective, net working capital equals current assets minus current liabilities. So this is the difference between both. Now we will understand behaviors. One behavior is if you are an old person. Generally they are more conservative. They want to keep cash with them. They don't want to be aggressive. They don't want to be more risk taking. So conservative capital policy is broadly you keep more cash with you for the rainy days. This is one. Opposite to this, we have aggressive working capital.